two things that I think that need to be taken into account. First of all, good for real estate in the sense that there's a lot of capital moving into those markets, hence why driving pricing. And if you have a large portfolio, your assets under management are increasing in value without you having to do a lot. So positive on that side. Negative, if like us and the other gentlemen on the table are trying to buy real estate in these markets, pricing isn't being driven by the fundamentals of real estate anymore. It's being driven by capital trying to seek a higher return than the fixed income can presently give. I.e., they're only looking at the margin between fixed income and real estate return. Now, is that the basis to be investing into real estate? We would probably say to a certain extent, no. We are a real estate-driven company, which means we look at the potential risks down the line with a lot of experience on a global platform on what can happen to real estate. And it becomes even more difficult when you're in these markets, which I find extremely crowded with very little stock. So I have to disagree with that. I don't see a lot of stock in our side of the spectrum of the market. And if you're pricing that steeply, you can try to be as risk averse as you want to be, but there comes a point that if you want to be competitive and actually allocate capital, that you're going to have to readjust some of that risk one way or the other in order to remain competitive in this crowded market. So positive for real estate, it becoming more and more professional, transparent, global, with a large depth of equity, and that drives a market as an asset class. More difficult if you go down into the markets and realize that capital is going into real estate, not driven by the understanding of real estate and its fundamentals, but being driven by its alternative to fixed income.